Good afternoon, everyone, and thank you, Fraser. I hope this will be fairly interactive. I mean, please, if you have questions at any time, just raise your hand and I'll try and spot you and give you the opportunity to ask a question. I always threaten audiences is if I don't get any questions, I may start asking you questions. So please, if you raise your hand. The other thing Fraser mentioned was the FT Wilshire GLIO indices. I would just like to say that these have been designed working with GLIO, so the industry has been involved in the design, and the industry is involved in their ongoing management. The whole purpose is how you define infrastructure, how you want to make sure the performance benchmark for infrastructure and all forms of infrastructure meets your needs is really to work with the industry and with GLIO to make sure benchmarks properly reflect that. You'll see a full description in your magazine. Please, any questions on that, happy to answer them. Okay, that's the end of the advert. We'll now move on to this panel, and we're lucky to have three excellent people here. Sandra Lee, UniSuper. We have Shane Hurst from ClearBridge Investments and Dan Kay from Frontier Advisors. We're going to start with Sandra, and really, I think, Sandra, it would help us if you could tell us a little bit about why UniSuper chooses to invest in infrastructure, whether listed or private, and how you go about it. What's your approach and what's your strategy?
Absolutely. Firstly, thanks for having me. Predominantly as an investor in unlisteds. Firstly, I must say I think I'm outnumbered in this room. So, given you all from either listed backgrounds or corporates, I'm currently head of private markets at UniSuper, and that picks up a portfolio of unlisted infrastructure and private equity. So that's a circa $15 billion portfolio. Having said that, though, I have actually worked in listed infrastructure myself, probably about a decade ago. I mean, Rod will be familiar with this. UniSuper actually took an approach where it went into listed infrastructure in quite a significant way, where we ended up being, the largest security holder in Transurban, Sydney Airport and APA. And I think the rationale there was very much we were agnostic to whether, infrastructure was listed or unlisted, and we were really guided by relative valuation. So as you know, sort of 10, 15 years ago, listed infra was relatively undervalued. So that was the rationale. And I guess to give you a bit of a sense with UniSuper's journey on infrastructure just more generally, I was just reflecting on this question, and I think we actually started investing in infrastructure about 25 years ago. This is UniSuper. So they were a very early adopter in infrastructure, predominantly in unlisted infrastructure. And, we acquired a lot of the airport privatisations. So, and we still have those investments here today. And UniSuper's now a controlling security holder or shareholder in Adelaide Airport. So the portfolio consists of, a significant stake in Sydney Airport, listed Transurban, and, over the last 5 years, we've done quite a few unlisted global deals in mobile towers. We've got a portfolio in Timberlands, PPP, so a pretty diversified portfolio. And I'll just go back to, I guess, that statement I said we were relatively agnostic sort of about 10 years ago. So we ended up being the largest security holder in Sydney Airport. And as it turned out, in 2022, when the take private occurred, it was actually beneficial for us because we were in the position of leverage where we said we wanted to stay in Sydney Airport, and we were agnostic this time, whether it was listed going into unlisted. And I think the deal couldn't really happen without UniSuper. So I guess what occurred at that point was we decided to roll our equity, being largest security holder listed in Sydney, into now unlisted Sydney. So that's been an interesting development for us as well in terms of our strategy with respect to infrastructure investing. Why infrastructure at UniSuper? I guess, I'm preaching to the converted here. You guys are all infrastructure investors in a big way. So I guess it's a lot of the unique characteristics that, convert into really attractive investment features. So things like essential services, market power, resilience, inflation-linked revenues, all those sort of good things that we recognise, and that's why we committed to infrastructure. And finally, just to sort of wrap up, our infrastructure portfolio as a fund today is circa 20 billion, so it's an important sector for UniSuper. Most of that, or I should say probably 65% of that's in unlisted infrastructure, and the remaining in either domestic listed or global listed infrastructure. So I might just pause there.
And so you manage with two separate teams, listed and unlisted? Is that the way you manage?
We do now. I think when we first started all those years ago, we were very much just the infrastructure team covering both. But as the strategy and the portfolio size grew, and as you get larger, things are just more complicated. Yeah. So I now manage the private markets component of the portfolio, so that's all the unlisted infrastructure, but that picks up private equity as well. And global listed infrastructures picked up and managed within the public equities team in the global side of the business.
And in terms of any sort of targets you may have, or when you're thinking about risk, are the two teams, are they different, or are they working to a common sort of set of targets and risk characteristics?
Yeah, I think we're pretty similar. So it's fair to say I think we've got strong dialogue across the group. We certainly don't operate in silos, notwithstanding obviously, the listed teams got sort of different things they've got to deal with, but fundamentally for us, we like, quality infrastructure companies, right? You want access to quality cash flows. So whether you're accessing those cash flows from a listed or unlisted perspective, I think we're probably a little bit more agnostic.
Okay. Can I ask a question on that? Sandra, how do you approach definition? Because obviously listed and unlisted definitionally can be quite different. Some of the recent acquisitions maybe or may not fit into the listed bucket. So how do you kind of think about that?
I mean, clearly, it's mark to market. It's got a lot more volatility. So compared to unlisted infrastructure, valuations are generally a little bit more stable.
Yeah.
So we get those things, but ultimately, I think because we're pretty long-term investors.
Yeah.
So we think, over time it converges, right?
So do you have core buckets and alternate buckets, and how do you think about that in the context of listed and unlisted? Because I can imagine unlisted very much depends on what's available, and listed is obviously what's listed, right? So
yeah, absolutely. So I think we're less of a bucket approach, a bucket-based investor, if you like. So we don't sit down and sort of craft a portfolio and say, we're going to have 30%, 40% transportation. I think we very much are opportunistic investors. So based on relative valuation, right? Because I'm not an infra manager, I guess. So diversification, whilst we have regard to it, it's not the single biggest driver. Just because we get diversification right across the fund, so so it's less of an issue. But if there's really compelling opportunities, for example, UniSuper did a deal in Vantage Towers that was Vodafone that listed their mobile towers business in 2021. Went through COVID. It was a really tough time. And tailwinds turned into headwinds, and we saw a real opportunity. Yeah. So we decided to sort of get in the consortium with KKR and GIP, and we put in over $1 billion into that deal. So that's one example where we were driven by the situation because it was highly compelling.
Yeah. And Shane, from your experience then, if we think about some of those issues, I mean, how do you see investors sort of getting exposure to both listed and unlisted? I mean, how are they going about this?
Yeah, look, I think, Sandra's right, they're definitely complementary. I think definition's really important though, and that's why I asked that question, because, our observation at least over the last few years is unlisted's access to core assets, the regulated utilities. We would invest in the leading type regulated utilities. You just don't see in unlisted funds, right? They're digital, they're renewable, etc. So whilst they're complementary, I think if you look at listed, you have a much greater choice of those kind of regulated assets, some of the concession structures, and our argument probably is you would have better assets in a listed sense. Now, it doesn't necessarily mean you can't risk adjust your returns you get in an unlisted sense, and obviously there are great assets if you risk adjust it, but I think you can have that definition drift that you don't have in listed because, for example, with our process, we have a very strict process of how we structure our universe, strict process of how we construct our portfolios, and then how we manage risk around that. So I think both are complementary, but for us, the benefits of listed clearly outweigh unlisted for those reasons, for the fact you do have liquidity, and then obviously valuations, as Fraser nicely put up.
Yeah. Well, Dan, maybe we get your view. I mean, also, if we go back to Fraser, he was trying to push us in a direction of, asking the question of really what's best, listed or unlisted. But I'm not sure that's quite the right way. But if you think about it, I mean, what do you see as the big differences between the two?
Well, maybe I'll just... Frontier's been advising institutional clients on unlisted infrastructure for 30 years. Obviously, when we started 30 years ago, it was unlisted. That's what there was. So the reasons why clients invest in infrastructure is exactly the same. It's those classic infrastructure characteristics, durable returns, inflation linkage, etc., etc. You all know well. We do have a bias at Frontier towards unlisted, and that makes sense, given our clients can handle, or most of our clients can handle, very long-term illiquid assets. But that's not exclusive. We do have clients who may have medium-term requirements for liquidity from their infrastructure bucket. They're not in inflow. So there are all sorts of reasons why listed infrastructure plays a role in portfolios, and many in the room are managing money here for our clients. I think in terms of are listed and unlisted the same, well, they should be. Sydney Airport, and we have these sort of discussions. I don't think the marginal dollar is the same anymore. It's the marginal dollar is not going to core assets, and it does make sense if you think of the really big pension funds have got all their core infrastructure. Yep. Occasionally, people swap airports in Australia or utilities in Europe, but effectively, they've got that really stable base. They've got that core. And now, I guess, look, what we see is whether it's infrastructure or it's not, it's renewables, it's digital, it's not. They're not targeting those core characteristics. Crematoriums, I mean, we see it all.
And if I can challenge you though, I mean, you have a preference, you're saying, for unlisted. I mean, if you were selling that, what would be your reason for saying you prefer the unlisted to listed? I mean, what's the benefits there?
I mean, look, Australian supers don't have or haven't had the benefit of investing in private equity, fees, etc. And so really, the control over the assets is good. And I think importantly, well, look, it's just an equity beta reduction. Yep. That's kind of the benefit of it. I think it is easier to underwrite a single asset rather than trying to, in some ways, pick a company that has many assets and many different divisions. You can get pretty granular, and that certainly is a lot easier in some regards. And I mean, I think it's just has suited our clients for a long time.
How do you reconcile the fact that you may not get access to those same themes that you can capture in listed?
It's a challenge. Yeah. I mean, so we have investors that have been invested for a very long time, and then we have new clients that we bring on. Maybe they're smaller institutions, and you're right, it is really difficult to get access to global utilities. It's really hard to get core infrastructure. So there's no way around it. I mean, it's getting harder in the Australian context. A lot of unlisted funds under pressure in Australia, and it'll probably get even harder unless you are capable of underwriting your own deals, doing your own transactions by yourself.
But if there is this scarcity of deals in the sort of the private market, I mean, do people see that this is going to lead to increasing demand in the sort of the listed infrastructure or not?
And there's no shortage of deals. It's just whether they fit within what you would think is core infrastructure. I mean, your future, your super has been a big challenge for all the superannuation funds, and it's pushing everyone up the risk curve. I mean, managers, listed managers, you know, they want to find uncrowded trades. Effectively, it is a little bit of an arms race. Alpha is beta's disguised as alpha, and it is a challenge. So really it's about understanding what those assets are offering and how it fits in the whole of portfolio context. Because I mean, if you're running a couple of $1 billion, you can probably afford, you can afford a small bet on, I don't know, maybe not American fibre, but other towers or other things.
Okay. And Shane, if I just stay with this listed versus sort of unlisted infrastructure, I mean, can listed be used as a proxy, or are they very different?
Look, I think it can be used as a proxy, as Sandra pointed out. There is, and as Dan pointed out, there is beta, and everyone here would know that. So every conversation you have with a client, it's like, well, this is a great proxy, has the same characteristics as Dan mentioned, but you know, you really can't get over that beta aspect. But I think listed has to be looked at a little bit differently, right? I mean, if you look at the themes you can access, I think they're far wider than you can get in a lot of unlisted portfolios. And I'm not saying all, I'm saying a lot of them. Whether it's the capex super cycle that's happening for regulated utilities around the world, whether it's the extent of AI and how that's benefiting regulated and especially names in the US, or the exposure to global pipeline companies you'd see in North America. You just don't get that scope, that diversification and exposure to those themes. And I think whilst you can talk about it as a proxy, because they do have the underlying characteristics, I think that's moving apart. So as Sandra mentioned, a few years back, obviously the airports and a lot of these funds were occupied by more core infrastructure. Now I think I was reading overnight, the 7th or 8th CIP fund was raised, and it's like a pure renewables fund. So very different exposures, and so not as much of a proxy these days, I would say.
But in UniSuper then, I mean, do you see, listed and unlisted, do you see them as complementary? Do you sort of think about how you blend them? Do you think about them as a total portfolio?
Yeah, absolutely, we do. So I think, with our GLI exposure, let's say, because now it's been, a little bit tricky in terms of sort of return. So I guess GLI sort of outperforms in sort of lower interest rate and sort of a risk-off environment. So, and we've certainly seen that. So we can use that as a lever, to some extent. So the short answer is yes, we do that.
Okay.
But ultimately, I think the focus and the driver should always be the best relative valuation for us as a fund. Where can we go access the best opportunity at a given time? So I think we need to have that financial discipline. So we're not capital allocators, we're really investors.
Okay, all right. I'm going to move on to sort of valuations. Any questions from the audience before I move on to that? Right, well, let's talk about valuations and differences. Let's start with listed and unlisted and the differences in valuations there. I mean, we've heard characteristics of these groups are different, so you'd expect some different valuations, but also the liquidity and the frequency, availability, scarcity, all of these things play into it. So maybe we can start with, Dan, we can start with you as to what you see as the main drivers of the differences here.
I mean, I think the way that we would say is there's always a value opportunity in listed infrastructure. It's always going to trade around and should trade around a lot closer to intrinsic value than broader equities. And so for clients who do have the ability to tactically allocate and take risk on and off the table, there is always a good opportunity to continue to sort of take those sort of basis points, which all do add up. Now, not every client is going to be in that position, given manage money in different ways. But we do think that there's, and I think it's been shown internally in our sort of capital market calls that there's an opportunity there. I think in terms of valuations of listed v unlisted, well, if we assume that they're the same assets, then yes, there is a valuation difference. But I think it is important to recognise that not all managers in unlisted are buying assets and holding them for core returns. I mean, it's really not the case. I mean, you've got the big private equity managers who effectively buyouts who'll be buying core assets and trying to extract value in the way that they do. I mean, I don't know what others think in the room about the latest Heathrow transaction. We spend a bit of time with the manager there, and they're not getting out of bed for anything less than 16%. So it's not core returns that they're targeting. They're not. So I think that you just need to be careful about just characterising. It's not as simple as that.
And that chart Fraser put up, which is a great chart, which is the last 20 transactions. If you look at those last 20 transactions and then you compare it to the index that we're looking at, the index multiples on the larger stocks would be far higher because they're different assets, right? So it's like for like. There is still a gap in our mind.
Okay.
I think it's worth making the point. It's different between unlisted and listed as well, right? So I know it's mark to market. You've got the daily sort of marking of pricing. Unlisted, generally we use independent valuers every quarter, so they're pretty regular. But one's sort of got the control premium, and one's really a unit ownership in an underlying security, right? So I think you're not sometimes comparing like for like. So I think it's important to make that point.
Okay. And Fraser was shown on the chart some valuation differences between infra equities and global equities. Your thoughts on the reasons for that? What's driving that?
Yeah, I mean, it's generally it should be the fair value of these assets, right? But if you look at the narrowness of markets, and again, everyone would have told the same story likely to their clients, but if you look at the narrowness of markets, for the most part over the last 2 to 3 years, you've seen the Mag 7, dominate the broader equity market. So, and everything else has been left behind, including infrastructure. Now, is it fair? Absolutely not. Do we think it's unjustified? Absolutely. Should we all be buying listed infrastructure? Absolutely. But it's just the way the world works. And in periods like we've seen over the last 2-3 months, it's like a thud coming back down to earth when people realise that these assets, as Fraser again showed in his charts, have very strong earnings profiles, very strong cash flows, deliver very strong dividends, and are really essential services. Right? They're not subject to business cycles.
Okay. But maybe we can think about some of the themes then that are driving infra. I mean, we haven't really touched on definitions of infrastructure, but let's think about some of the big themes that are coming through here. I mean, what do people think of the most exciting sort of themes that are coming through? Is it AI? Is it sort of the data side? Is it the energy demand? I mean, where do you see the big themes that you would be looking for?
Yeah, look, I mean, I think it's around decarbonisation, it's around digital innovation, it's around demographics. So they're all pretty compelling themes, and will throw up a lot of opportunity, a lot of capex to renew a lot of older essential infrastructure, build new. So I think there's, as Dan was saying, there's no shortage of deals, right? It's just, I guess, as an investor, it's just finding the right ones for your portfolio. So I think it's pretty interesting times and pretty exciting.
Yeah, for us, I mentioned, and similar to Sandra, I mean, that capex super cycle we're seeing in utilities globally, and obviously we have CEO of United Utilities here who's seeing massive amounts of capex over the next 4 or 5 years, similar to PCG and PPL who are also here. That is a really big feature of our portfolio. Whether it is replacement, resiliency, electrification, nearshoring. These are all big drivers of the companies, and they're multi-year. So, that's a big thing. AI for us over the last year or two has been massive. The impact on generation, the impact on transmission distribution, again, and another lever for utilities to pull when they're growing. Certainly they're two very big themes within our portfolio.
Yeah. And Dan?
Yeah, I mean, look, the themes that we see that are driving everything is digital and energy transition, however you want to refine that. And I think, one of the benefits of unlisted, if we're talking about the themes, is the ability to, I think, go in, access renewables in a package that is a little bit more suited to private markets, and that's been one of the. Renewables really is just. It's probably the only sector where you'll see dedicated sector strategies in infrastructure. But I mean, there's no shortage of opportunities.
How do you assess terminal? I mean, like the issue we always have in the discussion we always have is valuation, which it's you get access, but then you don't get the transparency. I don't know. How do you deal with that, Sandra? Yeah, with terminal value of those renewables.
It is tough. Yeah. Right? They're high risk, so you go in with your eyes open. So we did a deal with the Macquarie platform last year. And it's a full development, high risk strategy, right? But I think we recognise that, so we spent a lot of time just trying to find the right strategy. And for us, renewables is a really difficult one to do. I mean, we decided we were going to go with a much more diversified strategy across different markets, across different types of renewables, but not really into the funky stuff like hydrogen. So it was just utility grade, solar, storage, and onshore wind. But having said that, it's still pretty high risk. They're all in development. But I think you find operators and developers that have that industrial mindset that can sort of build their own sort of pipeline and ultimately, can deliver on sort of fully backed PPAs. Yeah. So, we won't take any sort of exposed risk.
One thing I'll say, Dan, just on your point there is one thing that I guess, and again, a lot of our clients use unlisted, but one thing you can't necessarily access for renewables is that regulated renewable growth, which most of our utilities are actually building in. So I think that is something that is even more secure than the contracted or the development PPAs.
Yeah, I agree with that.
Yeah. Okay. And I'm going to ask the audience for questions again. There's a question there. Was there? No. Almost a question. Almost a question. Okay. But then I'm going to sort of finish here by asking sort of views on future, how this both listed and unlisted is likely to evolve. Whether you see increasing allocations, whether you're seeing sort of new definitions, new types of companies coming into the market. So maybe we can just talk about that. So maybe Sandra, we start with you.
Sure.
How do you see this evolving?
I think there's going to be, there's already been an expansion of infrastructure to definition, right? We started off with core plus, there's infrastructure growth, infrastructure value add, now there's infrastructure adjacency, so we see it all. And ultimately, I think we at UniSuper are not particularly caught up with the definitions. It's all about standalone deals and whether there's sort of have the economic durability, those high quality characteristics we look for, because you can do good deals in that entire spectrum at the end of the day. So there is an expansion, and because I cover off both infrastructure and private equity, so we can certainly take a view. Sometimes things don't belong neatly in boxes. So it might not be strictly infrastructure, or it might be too low growth for private equity, and nobody wants to do it because they can't sort of work out how to sort of fund it in their fund. So that's certainly what we've seen, and we've stepped up to sort of do those kind of deals. Just be a little bit more agnostic around definitions.
Yeah. Sure.
So look, in terms of our view of the future of listed infrastructure, we obviously think it's bright. If you look at valuations, they're attractive. It doesn't really matter how you cut them, and that is driven by a couple of things. Well, really three things. Firstly, It's the underperformance some of these assets have seen over the last 2 to 3 years, as you've seen that lack of breadth, as you've seen bond yields kind of scream up around the world. That has created, no doubt, an opportunity. If you look at some of Fraser's charts, it's no coincidence they kind of coincide with bond yields moving up at extreme levels. So if your view is if your view is bond yields are going to stabilise or at least trade in a range going forward, then some of the true characteristics should come through. Because I think the second point to make is these are essential services, and so they'll continue to deliver year on year. And then, look, the final point is there's no doubt the themes are the strongest I've ever seen, and they're translating to stronger asset-based growth. You know, when your reg utilities are growing their assets at 8 to 10% per annum, and their EPS, you know, at 7 to 12% per annum in the US, you know, that is pretty much unheard of. So when you're seeing those types of tailwinds, it's got to be a good time to be in the space.
You hinted about some different valuations in different parts of the world, different regions. Yeah. Do you advise investors looking at regions separately, or do you tend to just take a global view? Look,
we take a global view. I mean, the portfolio is diverse enough, our universe is diverse enough, and you get different exposures in different regions. You know, Europe and European utility exposure is quite different than the US. So, yeah. Okay.
Future?
Yeah, look, we think the future's bright for infrastructure. Obviously, all the themes, whether it's listed or unlisted, are key in supporting the asset class. I mean, we're very mindful of sticking to core infrastructure, and we think that should you do that, you should be doing pretty well. Obviously, there is the creep that's going on. It is real, and just really it's about understanding what is actually happening at the assets, whether these are true infrastructure assets or whether you are taking industrial risk, because effectively that's what a lot of these new assets are. They're just highly predictable industrial assets rather than sort of core infrastructure. And so it's really about understanding that. But we see no shortage in the growth.
Okay. Well, we're coming to an end, but I know we've got a lot of investors in the audience. If you had to give one piece of advice for investors to just think about, what would that be? Go on, Dan, we'll start with you.
Go on, Dan. Give
you the easy question.
Come on. That's what you're here for.
Groom of listed infrastructure managers.
Well, Sandra here.
I'm gonna pass.
Boo! Come on, give some advice. No advice.
Go on, Shane.
Look, I think the space is very compelling, and you know, my advice would be if you can get through the volatility that we've seen. You know, the essential characteristics of infrastructure will come through in terms of listed returns, because they always do.
Yeah. And Sandra?
Agree. They're resilient assets. They're compelling, and you know, we can only look at the underlying thematics, and they're going to continue to grow, right? Yeah. So that's going to give us a lot more opportunities. I'm not saying every opportunity would be terrific, but I think you've got to be careful here. But I'm thinking there's no shortage of opportunities, so it's actually pretty exciting times ahead.
That's great.
And maybe just from me, I'll reiterate what I said last night. But I think it's just, look, buyer beware. You just got to get under the hood. Doesn't matter whether it's listed or unlisted. No sort of change in that. Really understand what you're buying, understand the risk profile. So yeah.
Okay. Well, thank you. Can you please say thank you to this panel? Thank you.